Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. 3 days after tax day, Saturday morning, coffee in hand, I'm looking at two numbers from my own accounts, and the gap between them is the whole reason I'm recording this episode. Hey, Prime investors, Martin Maxwell here. Welcome back to the 5-Minute Prime Podcast. The two numbers. It's April 18th, 2026. My tax return is filed. My accountant sent over the annual retirement account summary from last year. Number one, retirement balance at year end, $387,000, spread across an old 401k from a job I left 3 years ago, my current employer's plan, and a traditional IRA I rolled over once before and then kind of forgot about. Number two, dividend yield from the index fund that holds most of it, barely over 1%, 1.11 to be exact, near a 50-year low. Do the math. On $387K, that's about $4,300 a year in dividends for almost $400,000. Now, in the same year, a Cleveland duplex I bought with my own money, not IRA money, just cash out of pocket, produced around $9,000 in net rental cash flow on a $100,000 purchase. That was a good one. A more typical C-class Midwest duplex will hit 7 to 9, call it 8 on a realistic deal. Same economy, same year, 7 times the yield, same capital. That's when the question hit me. And if you've got a retirement balance, you've probably had some version of this question too. Why is $387K earning barely over 1% when the same money in Cleveland rentals would earn 7 to 9? And then the quieter question, is that even legal? It is. Most investors don't know. I call it the retirement property. A rental owned inside your IRA, funded by rollover money you already have, sitting in old 401ks. 4 steps to set it up. 3 traps that can blow it up, and 1 decision tree for whether it fits your situation. If you've never heard of this before, you're not alone. Most investors with retirement accounts have never been told self-directed IRAs are even a thing. Your 401k provider has no reason to mention it. Your index fund manager certainly doesn't. Your CPA probably said that's complicated the one time you brought it up. If this is new to you, it's not because you weren't paying attention. It's because nobody who makes money from your account being in index funds has any reason to bring it up. We're in the expand phase of the Prime framework today. Let's go. The 4-step playbook. Step 1. Open the self-directed IRA. A regular IRA at Fidelity or Vanguard won't hold real estate. You need a specialized custodian. 2 to start with. Equity Trust, which is the biggest by assets, and Directed IRA, which is the Matt Sorensen shop. He literally wrote the book. Setup cost is typically $200 to $500. Accounts open in 2 to 4 weeks. This is paperwork, not a decision. Step 2. Fund it. Here's where the unlock happens. You are not limited to this year's $7,500 contribution limit. That's the 2026 number, up a bit from last year. You roll over money that's already sitting in old 401s or existing IRAs. Tax-free. No dollar cap. That's how most people get to $100,000 or $200,000 in the SDIRA quickly. They take dormant money from jobs they already left and move it. Step 3, buy the property. The title goes in the IRA's name, not your name, not yours and spouse's name, the IRA's. Your custodian signs the offer and the closing paperwork on behalf of the IRA. If you want more direct control, there's a structure called a checkbook LLC. Your IRA owns an LLC, and you're the manager of the LLC. You still can't own it personally, but you don't have to fax the custodian every time the plumber needs $200. Step 4, let it run. Tenants pay rent directly to the IRA custodian or to the LLC bank account. Expenses pay out of IRA funds. Appreciation compounds tax-deferred in a traditional IRA or completely tax-free in a Roth. You don't touch a penny of it until retirement, but your retirement grows at 7, 8, 9% instead of barely 1. Back in episode 94, we talked about using real estate as your pension, the cash flow from rentals replacing what the defined benefit plan used to provide. Today is the same idea one level deeper. Instead of real estate replacing your retirement account, we're putting real estate inside it. The 3 traps. Now, this strategy is powerful. It is also unforgiving of mistakes. 3 traps. Trap number 1, the personal use trap. You cannot spend a single night in this property. Not one Airbnb weekend, not a family Thanksgiving. Your spouse can't use it, your kids can't use it, your parents can't use it. The IRS calls these folks disqualified persons. And the moment any of them use the property, the IRS treats your entire IRA as having been distributed. That means full income tax on the whole balance, not just the property, the whole IRA, plus a 10% penalty. This trap has vaporized more SDIRA strategies than any other. If your kid's getting married in Cleveland next summer and your SDIRA happens to own a great house 5 minutes from the venue, find a different Airbnb. Trap number 2, the sweat equity trap. You cannot fix the AC yourself. You cannot paint it. You cannot pull permits in your own name. You cannot pay yourself a property management fee. All work gets paid for out of IRA funds to unrelated third parties. If you love Saturday morning landlord work, this is not your strategy. This is the single most disappointing rule for handy investors. You're a capital allocator here, not a contractor. Trap number 3, the UBIT trap. Here's the one most SDIRA tutorials forget to mention. If you buy the property with leverage, meaning you take out a non-recourse loan inside the IRA, where the IRA borrows from a bank to buy the property, the share of your rental income that's coming from the borrowed money, not from your own IRA funds, is subject to something called unrelated business income tax, UBIT. It runs roughly 20 to 30% effective tax, but only on that leveraged share. It is not fatal. You still come out ahead versus the index fund. But a listener who walks in thinking 100% tax deferred gets a surprise on their first 990T filing. The fix is simple. Buy all cash inside the IRA, no debt, no UBIT. If your balance doesn't support the purchase all cash, you either wait until it does, or you accept UBIT as the cost of getting in. 4 steps, 3 traps. Now the decision. Here's your challenge for tonight. 1. Pull every retirement account statement you can find. Old 401ks from previous jobs, current 401k, existing IRA, any Roth you've forgotten about, add them up. 2. If the total is north of $100,000, you have enough for this to be worth the setup cost. 3. Request a free info packet from one SDIRA custodian, either of the 2 I named, Equity Trust or Directed IRA. Arrives in your inbox in 10 minutes, takes 10 minutes to read. You are not committing to anything. You are collecting the information your 401k provider was never going to send you. 4. Tomorrow morning, 15 minutes on the packet. If the math still works, book the free 30-minute consult. If the math doesn't work for your situation, you'll know why. And you can make peace with the barely 1% dividend yield. But you'll have actually decided, which is more than most investors ever do. Thursday, we've got the Powell spread, 53 basis points of mortgage rate movement in 12 months with 0 Fed cuts. Why that matters for every deal you're underwriting. And next Monday, the tool that tells you in about 8 seconds whether the specific property you're looking at is worth wrapping into your IRA in the first place. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one step at a time.